How America's fiscal nightmare could cause a repo rate crisis, thereby blowing up the $1.8 trillion basis rate. Here's the math linking the fiscal disaster, bond market problems, TGA rebuild, liquidity shortage, repo market stress, and the basis rate. So, Luke Gromen and Preston Pish, there was an excellent interview recently where Luke Gromen flagged this issue, and I want to walk through it with some math and with some charts. Of course, we've been talking about a lot of these issues going back the past several months. So, to start with, here we have the federal deficit. Now, remember, this is the difference between what the government spends and what it collects via revenue. We can see that that deficit is growing at an 8.2% compound annual growth rate going back the past 25 years. GDP, or the economic output of the U.S. economy, only growing at 4.4% compound annual growth. Therefore, the deficit as a share of GDP is growing at a 3.1% compound annual growth rate. Not only that, but it is a pro-cyclical deficit, going from a 3% budget surplus to a 6.5% budget deficit, despite the fact that unemployment has gone sideways. Now, not only that, one of the things driving the deficit is interest expense. So the average interest rate on our marketable debt is 3.3%. As we can see, the past couple years, there has been nowhere on the yield curve where you can issue at 3.3% or below, meaning that as debt is refinanced, remember, we never repay old debt. We just refinance it. We issue new debt securities to pay back the holders of the old debt security. So as debt is rolled, and of course, new debt is issued, and we just covered that new debt, that annual deficit, is growing at an 8.2% CAGR. So not only as the debt is being refinanced, but as that new debt, growing at an 8% CAGR, is being issued, it is being issued at higher interest rates, thereby driving up interest expense, thereby driving up the deficit. Not only that, but the Fed has been engaged in quantitative tightening, which is a negative for liquidity. And here we can see their notes and bonds have declined by 29% since quantitative tightening started. And not only that, but gold is rapidly replacing the U.S. Treasury as a global store of value, as a global reserve asset. Here we can see wildly outperforming the long bond, even factoring in yield. Once you take the total return of the long bond and divide it by gold, it is underperformed by 82%. So if the long bond is underperforming, no one wants it in terms of foreign demand. What do you do if you're the government? Well, remember, this is the government's checking account. If no one wants your long bond, you just shift to bills, which are short-term debt securities. Think a 4-week Treasury bond. It is called a bill, a very, very short-term debt security. What that means, though, is that you must be constantly rolling over. Again, we established that they never actually pay back the old debt holders. They just issue new debt. And of course, that is being rolled at ever higher interest rates, as we saw before. Here, by the way, is a table showing the nominal amount and the percent of total issuance. 1-year bills, 77% of total issuance. And of course, the total amount of issuance is growing at an 8% CAGR, as we just covered. Well, that means the government's checking account needs to have a ever larger buffer. So here, by the way, tweet from Andy Constant and an exchange, or part of an exchange, from John Kaminsky and Luke Gromen. Over on the left, Andy Constant establishes that the reason the TGA is so large, up at $1 trillion, is that currently the U.S. Treasury has $6.4 trillion of Treasury bills outstanding. Those short-term debt instruments, remember, that $6.4 trillion will grow at an 8% CAGR. Bills require refinancing quite frequently. In fact, every 5 days, the amount of redemptions is $550 billion, $500 billion every 5 days, and that is an average over the past 6 months. Therefore, the TGA must be that large because, again, remember, they need a 5-day buffer. And over here on the right, Luke Gromen goes back with John Kaminsky about this kind of treadmill effect where because old deficits are kind of being issued at higher interest rates, and of course in bills, shift from longer duration debt that we might have issued in a 10-year 10 years ago is now being refinanced in a bill. You get this kind of compounding effect, this treadmill type problem where you have to run faster and faster just to stay in the same place because deficits are growing at 8% CAGR, and more of those deficits are being financed in bills, meaning more and more buffer must be built into the TGA. Well, remember, a buffer in the TGA, the government's checking account, means it's got to come from somewhere. Again, this is money just sitting in a checking account that the government, the Treasury, has at the Federal Reserve. Well, of course, this is when we initially flagged the coming liquidity crisis. It was back in, I think, late July when Scott Bessent announced the Treasury general account would be rebuilt from 300 billion to 850 billion. I took one look at the RRP, the storage tank of excess dollars, sterilized excess liquidity at its peak, 2.5 trillion. And I thought, well, the RRP's only got about 150 billion, meaning it's got to come from bank reserves. Well, if you are decreasing bank reserves, as we can see the green line here, bank reserves inverted. As the green line is going up, bank reserves are going down. In fact, from about 3.4 trillion down to just about 2.8, 2.9 trillion. As we can see, that has a very, very strong correlation with the SOFR spreads. Remember that repo market, $3.2 trillion financed every single day in the repo market, and SOFR is the secured overnight funding rate. That is the interest rate based on supply and demand for overnight loans, for overnight dollar loans, collateralized dollar loans. The actual interest rate based on supply and demand, actual liquidity conditions, minus the RRP. Now, remember, the RRP rate is the lower bound for the Fed that they use to control or try to control the overnight interest rate. And we can see that as bank reserves go down, sharply down, we can see SOFR spreads sharply increase. And likewise, as bank reserves go up, we can see that SOFR spreads come down. The RRP, by the way, is basically empty. And of course, the Treasury general account is standing at about $900 billion. So I want to point out that the repo rate crisis of September 2019, I will link some videos at the end. We've been covering this obviously for many months now, but that occurred when this SOFR RRP 10-day moving average, again, there's a lot of volatility day to day with SOFR. So it's important to look at a moving average, I think. That moving average was actually trending down. Yes, you did have periodic spikes, but in general, that was actually kind of trending down. What we see today is that moving average trending up. And so, of course, the Fed just put out a white paper about a couple weeks ago mentioning the massive undercount for Treasury holdings by the Cayman Islands. Cayman Islands, annual GDP of about $7 billion. So why do they hold $1.8 trillion of U.S. Treasuries? Well, it's all the hedge funds in the Cayman Islands, headquartered there, that are in the basis trade. Now, the basis trade, 50 to 1, 100 to 1 leverage, and they undercounted the degree of Cayman Island holdings by $1.4 trillion. I will link this Fed white paper in the description. They note in the white paper that the basis trade was partially unwound in March of 2020 in response to significant strains in Treasury and repo markets. They point out, by the way, that it's actually grown even larger than it was back then. So just to recap, what is oh, by the way, before I finish here, we have another top Fed official that is warning about this liquidity issue, the potential for another repo rate crisis. Here, I will also link this in the description. Lisa Cook, governor in charge of financial stability at the Federal Reserve, warning the risk of the basis trade to the $30 trillion U.S. Treasury market. Remember, an unwind of the basis trade, which is short futures, long cash Treasury, would be the opposite. You'd be forced to buy the futures contract and sell the U.S. Treasury. Now, we saw this in March of 2020. We saw this in early April. It causes significant issues in the U.S. Treasury market. Of course, we saw in early April the 10-year Treasury yield spiking more than 70 basis points in just a couple days, in part due to the basis trade starting to unwind. Of course, Fed governor in charge of financial stability warning of the risk that this basis trade could have. So to recap here, we have an ever-growing larger deficit, 8.2% compound annual growth rate. That deficit is pro-cyclical, and we are financing that deficit at ever higher interest rates. As old debt that might have been issued down here is coming due, we are rolling it at higher interest rates, number one, increasing the deficit even further. But not only that, issuing it in bills. And because of the bill issuance. The bill issuance is due to the fact the long bond is no longer a good global store of value. So we are rolling more and more of that old debt that might have been a 5-year, 10-year, 20-year treasury issued at these lower rates back here. We're rolling that into a higher interest paying and, of course, a shorter duration. Well, that shorter duration means that the government's checking account needs to have a larger buffer. Well, again, if the government's checking account has a larger buffer, again, we are the redemptions per 5 days, $500 billion, according to Andy Constant. And of course, that deficit that is ever more and more in bills, ever more and more at higher interest rates, the deficit's growing at 8% CAGR. Remember, this will be growing 6.4 trillion of bills outstanding. That will grow at an 8% CAGR. So that 550 billion in redemptions, not even counting, by the way, end of month coupon maturities that add up to $300 billion. That will only grow as we shift more and more of our debt, refinance more and more of our debt into bills, and bills that are obviously have a higher interest rate, thereby also increasing the deficit. Well, as the TGA is rebuilt, that'll have a negative impact on bank reserves unless the Fed comes in with quantitative easing or some way to inject new bank reserves. The TGA, as it grows over time to cover the ever larger amount of redemptions due to ever larger amounts of bills, due to the fact that there's no demand at the long end of our yield curve. Well, of course, as bank reserves go down, SOFR spreads go up, tightness, liquidity tightness increases, and you can have, of course, what we had in September 2019, repo rate crisis. By the way, the $1.8 trillion basis trade is financed in the repo market. So when you have SOFR spreads blowing out, the financing leg of that basis trade gets stretched, causing an unwind, of course, forced U.S. Treasury selling. Never a good thing. One more top Fed official. I will add it to our kind of running timeline that we have of all these various top Fed officials warning about liquidity issues, repo market stress, so on and so forth. So anyways, hopefully that was helpful, and I'll catch you in the next one.